Hi everyone, this is a short screencast covering Section A for the mock exam for F6 Taxation Accountancy School for December 2015. And what I'm going to do within this screencast is just run you through questions 1 to 15 in Section A and indeed the answers, and just try to give you a feel for where the problem areas are, perhaps where you may have fallen down, and perhaps the areas that are likely to come up in the real exam. Okay, so question 1 here clearly relates to the 2/3 rule for VAT purposes, and you'll see in this question that we have individual called Paddy. They introduce him as a plumber, and they use this area of this repair to a movable good. So we'd be looking out on the real exam for some sort of repair by an individual to perhaps a dishwasher, washing machine, etc. Now, the key aspect of the 2/3 rule, as we should know, is really the differential between the 23% rate and the 13.5% rate. And the problem that we'll have is that they'll provide us with details in relation to labour and indeed parts, and they'll also give us some form of total. And really what we have to do is to see whether or not the cost element of the parts is above or below 2/3. Okay. Now, the issue in this particular question, which is not unusual, but it doesn't always surface like this, is that really what they do down here is that they provide the detail of the actual cost of the parts, indeed including VAT. What it would have been easy to do is just look at this area here, in other words, the invoiced value net for the parts element. And the 2/3 rule is based on the cost of the part. So really what we had to do is to look down at this figure, and say, well, that includes VAT. Let's extract the VAT, and then let's just compare that net amount after we've extracted the VAT or imputed the VAT to the overall figure of 300. So I think what we might have done in the real exam is to use this area of the 180 and perhaps get the answer wrong. Okay, so quick summaries. 2/3 rule. We know that in essence what we're trying to do is to help this individual Paddy come up with his sales invoice. In other words, does he apply 23% or 13.5%? It's all concerned with the this 2/3 or 66.6% area, and whether or not the ex-VAT cost of the parts is above or indeed below that. Okay, so if we look at the answer for this one, I've done a lot of sort of annotation to this, so hopefully it will make sense. We see that the ex-VAT cost of the parts is actually 140. How do we get to that? Well, we took that 172 and we imputed the VAT effectively. In other words, we took out the 23%. Once we have that, what we're looking to do is to compare that imputed amount, i.e. 140, to the overall cost or the overall net invoice value as shown within the question of 300. Okay, so in effect what we have there is 140 over 300. That's 47%, which clearly is less than 2/3. Now, if it is less than 2/3, then we're going to use the lower rate of VAT on the whole invoice, i.e. this 13.5%. Okay, so in effect, the VAT charge is going to be the net amount as shown per the question of 300 times 13.5%, as you see here. Okay. So, do look at this 2/3 rule. It's very, very popular. It doesn't have to appear in the MCQ questions. Could appear in the longer VAT questions. Pretty popular. I would expect certainly more than 50% of the time for them to examine the 2/3 rule. So do get a fix on that. Okay, that's question 1. Question 2 was ethics. Really to do with sort of ethical behavior for the accountant, and not a lot of information in the text about this. What I would suggest is that you learn that mnemonic COPPI, which is really the fundamental principles, fundamental ethical principles as far as the ACCA are concerned. What does that stand for? Copy, well, really confidentiality, objectivity, professional behavior, professional compliance, indeed, and integrity. Okay, so really they are 5 principles, ethical principles that we need to adhere to. Not usually a lot of marks in an exam for the ethical area, 2 in fact in this exam, and if we learn the mnemonic and learn what it stands for, then we should be able to score the marks. This first one here was clearly integrity. In other words, the idea of being honest. Yeah. The third one, C, talks about avoidance of bias, and that is certainly objectivity. That's what that means. Do not be biased in your business dealings or have any conflicts in any way, shape, or form. And D here was just compliance or professional compliance, and that's really just, being competent, keeping up to date and being able to do every job that comes your way, and not certainly offering your services in a situation where you're not qualified to actually provide proper advice or to do the job properly. So in this case, the B was the answer, because in effect what professional behavior means is not really bringing the profession into disrepute. In other words, not doing anything that would mean that people would look in a sort of a disadvantaged way on the ACCA, on the institute. Okay, so really B was the answer there. Okay, next one, 3, was just this area of residency. Now, we should know in relation to residency that we have 3 main rules, don't we? Well, 2 main rules and then an add-on. We have the 183-day rule. We have the look-back rule, which they also test within this question. And then we have the third way to be resident in Ireland, which is basically just voluntarily. In other words, you decide to contact the revenue and say, I'd like to voluntarily be a resident. And you probably do that to your own advantage in some way, shape or form. But certainly the first 2 are what they're testing in this question, and indeed what they're likely to test within an exam. And I think the difficulty here is that we had a number of different periods, a number of different days, and we really had to have a good fix on how the first 2 rules work in order to be able to get the right answer. Okay, so the question basically says, which one is resident in 2014 for tax purposes? And really it's a process of elimination. We have this first guy, Paddy, been living in London, therefore non-resident for the past 5 years, returns to Ireland 1st of August, and he is present for the remainder. So it's really just a question of saying, okay, with Paddy, how many days has he been in Ireland in 2014? And you'll see I haven't calculated, but clearly it's less than 183 days. 183 days, basically half the year. If he's arrived in on the 1st of August, then clearly he hasn't been resident or indeed present for more than half the year. Therefore, he's definitely non-resident. That cannot be the answer. Okay. In relation to B, John, looks like he's present in Ireland for these periods, or indeed for this period. Looks like it straddles 2 years. This is typical of what they'll do. And you really have to be saying to yourself, okay, well, what are the number of days in 2013 in the calendar year? And indeed, what are the number of days in the 2014 calendar year? And if you calculate those days, you'll see very clearly that he's certainly not in Ireland for more than 183 days in 2014, because he's only there from 1st of January to the 31st of May. In addition to that, so that discounts rule 1. In addition to that, in relation to rule 2, the look back rule, which you'll recall is more than 280 days across 2 tax years, and indeed more than 30 in the current year. So on that basis, he certainly doesn't comply with rule 2 either, because he certainly does not have more than 280 across the 2 years, 2013 and 2014. So he's definitely not resident either. Now I'll just go down to D, because clearly C is the answer. We see here that Mary has lived in Ireland all her life. That might sort of make us think, oh, well, that sounds good, maybe she is resident. But if we look to see that the rest of the question, it says she leaves on the 20th of January 2014 and doesn't return until the calendar year 2015. So the way I see that very quickly is that if she leaves indeed on that date, she has only been in Ireland for 20 days effectively in 2014. So although in the previous year, as I've said over on the left-hand side here, in the previous year, she will have, sorry, that refers to C. In the previous year, she will have had, in effect, 280, or indeed a large number of days, effectively 365. This is Mary for D. She will not have had 30 days in 2014. So in effect, she has less than 30 in the current year, although more than 280 across the 2 years. Therefore, she must be non-resident. Okay, so that only leaves us with C. So how do we make C work? You'll notice that they've mentioned, non-domiciled or non-Irish domicile individual. That doesn't matter at all. What we're talking about here is residency. So that's a standalone area. We just have to apply the normal rules 1 and 2 and figure out whether or not this person complies with either one. Okay, so we see that Joe, he's non-Irish domicile, which is irrelevant, present for these dates in 2013, May to 20th of October, and indeed in 2014, he's present from March to the 28th of June. Now, if we calculate the days, and we really had to do to get this right, you'll see that that's the number of days in 2013 and 120 in 2014. So in fact, in total, he has 293. And on that basis, that satisfies the first part of the look-back rule. We then effectively have to say, well, is he also in Ireland for more than 30 in the 2014 year? And effectively, if we look at 1st March, 20th June, he clearly is. So that's why C is the answer in that case. Okay. Now, next one here is a question relating to sort of BIKs, and I'd certainly tip BIKs to come up in your exam. It has to come up, and the key first point for me in relation to benefits in kind for Schedule E employees is really the point that I've made up here in relation to short periods and contributions. Okay, now contributions wasn't relevant in this question, but certainly short periods was, and as I've said here, I think there's actually an error in this answer, but more of that later. So in essence, we're talking about someone who is employed, some sort of benefit needs to be calculated, and we just really have to watch out for the little tricks, and indeed, as I've just mentioned, watch out for them shortening the period. I mean, if the benefit isn't available for a full 12 months, then it's not assessable for a full 12 months. Okay, so really do watch for that, and as mentioned, watch out for contributions as well. In other words, payments by the individual really to reduce the benefit. Okay, so what do we have? Well, we've got James. He's an employee. He's got a company car from the 1st of July. Okay, so in effect, what we're saying is a benefit in kind has been available from that date onwards. What is it? It's a car, and we need to know that basic rule OMV times 30% and adjusted relevant to business mileage. Now, what they do here typically is that they give you a second-hand value of the car. That's completely irrelevant. It's a red herring, and we're not interested. We're only interested in the OMV, and that's 40k. They also tell us, as they probably will do, that the individual drove the car for a number of business miles. In this case, note that it's 13,000 business miles, and that's key obviously to establishing the percentage. You'll note within this PDF that where I've highlighted the number in red, then we're going to go to the answer itself. So really what we have is, how do we calculate a car benefit? And the basic rule, as I just said, is 30% times OMV. Now we look at the question, we'll see that there are a few just adjustments that we may have to make, subject to obviously periods and indeed any issues with regard to business mileage. Okay, so if we look at this number 4, excuse me, watch it, there's no number there, but you'll see that what they start off with is basically the OMV, the 40,000. They ignore the second-hand value times 24. So we need to figure out, well, why is it 24? Why isn't it the normal 30%? You'll see over to the right-hand side where they get to that figure. And obviously note that your tables are helpful here. Okay, I'll come back to the short period in a second. So where do they go to get the information in relation to the business mileage? Well, the business mileage in the question says 13,000, And note that the car is only available for part of the year. In other words, 6 months of the year, as I recall. So what we need to do is really inflate that, i.e. 12 over 6, and then compare it to the tables. And what you'll see that at 26k of business mileage, the percentage actually reduces to 24%. Okay, it's not 30. In essence, what they're saying is the higher the business mileage, the lower the benefit in kind should be for the individual. Okay, so that's where we get the 24% rather than the 30. And you'll see here that what they do is they simply multiply it by 6/12 being the short period, i.e. 6/12, as shown by the question. It's 1st of July. In fact, no error here. Read the date. In fact, that's another question. Okay. So in summary then, we basically need to know the basic rule, the 30% times OMV. We need to watch for business mileage, look to our tables and inflate if necessary, as we had to do here, and then just be careful to reduce the benefit down again if the car is only provided for part of the year, as in this case, 6/12 of the year. Okay, so that's number 4. Let's move on to number 5. Ignore my note about the error. The answer was A in that case. The next one here is just a little bit of administration. As I've said in classes, let's just rote learn these dates. Not much to it apart from the fact that we should know that October in each year is the date for final tax, and indeed, as per this question, preliminary tax for the year as well. Okay, so nothing much to that at all, except rote learning. With your administration studies leading to the exam, little and often is the best way to do that. Don't spend 3 or 4 hours trying to learn off, revenue audit and self-assessment. It's a little bit dry. Just little and often practice a few questions and then move on to another area. Okay. Now, next one is this PRSI question. Quite popular PRSI calculations, and I guess well suited to multiple choice questions or MCQ questions, along with USC, of course. Okay, so we've got this individual, John. He has a salary of 70,000. He's made pension contributions of 12,000, and he also has some deposit interest or DIRT interest of 2,950. And they're asking, what's the amount of PRSI payable? So I think the key thing for us in relation to PRSI or indeed USC is just having a quick note or a mental note of really the formula for the calculation. And in essence here, what we'll see when we come at the question is that the pensions are basically completely ignored. That's number 6 here. Pensions are completely ignored. They're not deductible in any way for PRSI or indeed for USC. So we're trying to figure out what is the amount of income that's really chargeable to PRSI. Now, in this case, really per the question, we only had 2 types. It was the salary, that's definitely chargeable, and also the DIRT, noting that it's provided to you net. Therefore, you must gross up by our normal fraction of 100 over 59. That gives us 75,000, and we simply multiply that by the 4%. So in summary here, let's just note, PRSI, basically all income is included. The only thing that I can think of that can be deducted is capital allowances, and in fact they will be deductible for PRSI purposes and USC, but certainly DIRT for PRSI is included. It's included gross. Pensions definitely not deductible. Okay, so that's number 6. Let's move on to number 7. This is a lease car issue. In other words, this company is hiring a car for their CEO. There certainly is an error in this question. I got this mixed up with number 4. There's an error here, so if you did get it wrong, don't be overly worried about it. I'll explain the error in a second. So what they're testing here, and they love cars, is really just this area of emissions and how that affects deductibility of lease payments for a limited company, and indeed it affects sole traders as well. So what do we see? Well, we've got a company leasing a car from this date. Now watch that date, because that's important in this question. For the CEO, the annual lease rental is 6. Note that the annual lease rental is 6. Okay, so it's only available for part of the year, but the annual rental is 6. Retail value of the car is 38,000, and we see that emissions are 150 GKM. We see also that they've thrown in this sort of little 60% just to see whether or not you bite at that. And in fact, you know, in this case, we don't. We're not really overly interested in this area of private usage for limited company employees, because as we should know, that the individual will be assessed to a benefit in kind, a car benefit in kind. So in fact, this 60% wasn't relevant at all, in the same way that it wouldn't be relevant in relation to other motor expenses. Okay, so the question really is, given what they've said above, what's to be added back in relation to this calculation of case 1 income for the year? So really what we've got to do is we've got to know the formula, and certainly the tables are helpful for this. Certainly it's a Cat A car, clearly, so it's in that first group of A, B, C, and there's a specific calculation which we'll see in a moment. So the key elements are the GKM, which gives us the Cat, and then the actual retail value of the car. Okay, so if we look at question 7 here, sorry, the answer for 7, what you'll see, and the problem that I think is the error in this question, is really that they've taken 6 months when in fact it should be 7, because the car was made available, I believe, on the 1st of June. Okay, so in fact it's 7/12. But let me take you through their answer anyway. We see that the lease cost for 6 months is 6/12. So really what they're saying is that what would be included within the normal profit and loss account would be 3,000. Okay, so in effect 3,000 is the normal cost. Now what they do here is that they take this 3,000 and multiply it by this formula. Now this formula is also incorrect. Okay, I've done the adjustment over here. I'll explain that in a second. In essence, what they're saying is, okay, give us the chargeable figure for the profit and loss for the correct period. They call it 6 months, which is 3,000, and then take that and multiply it by this little formula. In other words, in effect, restrict the value that can be included as a deduction. Okay, so where have they gone wrong outside of the date? Well, really the first thing is, as I said, the 7/12, so it makes it 3/5, but this formula is wrong. It should actually have 38 on the bottom, not 24, as you will see here. So the formula for Cat A, B, C should be the full value of the car, the OMV, 38, minus 24 divided by 38. Now that will actually give you 1289. Okay, so that in fact would be the answer to this question, allowing for, in effect, 7/12. Okay, so just watch out for that. If you did get this wrong, you know, perhaps you worked it out in a different way and couldn't get the answer. Okay, so that's number 7. Let's move on to number 8. Now, this question here is, you know, I think it's extremely tricky. I think it's a little bit more detail, or a lot more detail than we would probably expect to see in the real exam. I mean, the real exam, what we should need to know is that certainly disposals between spouses or civil partners are on a no gain, no loss basis. In other words, there's no CGT at the date of disposal. And what they've done here is maybe just go a little bit more detailed than I feel that we need, but let's go through it anyway. The question says, you know, what is not correct in relation to disposals between spouses? And what's not correct is certainly C, which I'll come back to. A, B, and D are clearly correct. Let's look at A, for example. So they basically say, you know, married persons who are living together and indeed Irish resident will qualify for the exemption. That is true. The little sort of rule that we might want to remember there, which I don't think is overly examinable, is just this idea that if you do have spouses or 2 spouses and the receiver is non-resident, in other words, the person receiving the asset is non-resident, then that transaction will not be no gain, no loss. In other words, because the receiver of the asset, let's say it's a house, is non-resident, you will not be able to, or those individuals will not be able to make use of the exemption for CGT purposes. Okay, so, small little area, I wouldn't get overly worried about it. Okay, now the next one here says, where the exemption applies, the transfer of the asset from one spouse to the other is treated taking place at no gain or loss. That's fairly straightforward. That's the sort of way that we know the rule. I don't have a problem with that at all. It's nicely worded and very, very clear. This next one here, I'll go down to D. C is the answer, and I'll explain why in a moment. A disposal between an Irish resident married persons under a court order is exempt from CGT. So again, that is correct. I mean, our basic rule is that the people need to be living together. Yeah, but let's just say that we have a situation where they're not living together, and indeed they're about to get divorced under a court order. Then certainly any transfer as, let's say, part of the divorce settlement from one to the other is exempt. Okay, so what are the main areas where the no gain no loss rule for spouses or civil partners does not come into play? In other words, when does it not apply? And I've listed just on the left hand side here for the sake of completeness where it would not apply. The first one is just as mentioned in relation to A above. In other words, the receiver is non-resident, then it wouldn't apply. Okay, it would be a normal transaction between two individuals, a normal CGT transaction. And the only other situation is if they're not living together and the transfer is not made under a court order. Okay, you'll notice that D here shows that the transfer is being made under a court order. Okay, so a little bit more detail than I think we require, but certainly included within your mock exam may have caused you a few issues. Now, this one here, C, why is this the answer? In other words, why is this not correct? Well, strictly speaking, it's for the reasons that I've just described. In other words, we're effectively saying if there are exclusions to the no gain no loss rule, then strictly speaking, disposals between all married persons are not always exempt from CGT. So in effect, we're saying it's not correct. We're saying, in effect, just because you're married doesn't mean you get the CGT exemption, and these are certainly two of the main areas where it's not going to apply, two of the only areas, in fact. Okay, hopefully that makes sense. Next one is, I believe, a termination issue. So we've got our old favorites, the three exemptions. They've asked us for, the taxable termination payment, and there are one or two little tricks in here which I'm hoping that you will have remembered and maybe had a good stab at this question or getting it right. So what do we know? We see that Brenda's made redundant partway through that the year on 30th of April, employed for this period, this is important, 12 years and indeed 6 months. Okay. Various payments provided to him, statutory redundancy, 14,000, ex gratia, that's an important word there, of 42. Then they give us the average annual emoluments for the 36 months to April being 64, and they give us the actuarial value of the pension lump sum being 18.5. So really what we've got here is, and I'd certainly refer you to your tables in this respect, because really all the information is there in order for us to get this question right and to make sure that we avoid the little tricks and traps that they've set for us. So really what we've got to do here is really look at the payments that he's received. There are only two of them, statutory redundancy and an ex gratia payment of 42, and say, okay, which groups do they fall into? How are we going to deal with them? And then in this area of the partially exempt group, we've really got to work out our three exemptions, find the highest, and then compare it to the partially exempt group. Okay, so what you'll find within the answer 4.9 is a number of different things. Certainly I've annotated this quite comprehensively. We'll see in this first part here, we're really saying, okay, we're going to work out the higher of the three exempt amounts. Remember that the numbers or the formulas are in the tables. Okay, and once we've done that, we take the higher and compare it to the partially exempt amount. Now, on this issue of the partially exempt amount, looking at the question, there are only two payments. Statutory redundancy is always exempt. Yeah, and what do we mean by that? Well, we mean that in effect, it's not to be included in the income tax computation, or indeed it could be included, but we'll say exempt. Okay, so make that clear if this does come up in a written question. Make it clear that that statutory redundancy is exempt. Zero, nothing taxable of it. The only other payment was an ex gratia payment. And you remember from our group of partially exempt or ex gratia payments, we're really looking for things that are not per contract. What does ex gratia mean? It basically means sort of like a goodwill type payment. It certainly wasn't included in the individual's contract, which was agreed 12 and a half years ago. Okay, so this is the one that we have to compare to our three exemptions. Once we found the highest exemption, compared to that, and the difference is what becomes the taxable termination payment. Okay, so back to the question here. In effect, we're saying there's going to be three exemptions. What's the highest? Now, the first one here, this 10160, that's in the tables, and it's just simply 10160 plus 765 times the number of complete years, not part years. We're not putting 12.5 into there, and I would expect them to play that trick every single time this question comes up, whether it's MCQ or otherwise. Okay, it's only complete years. So that gives us the basic exemption at 19,340. Now, in terms of the increased basic, you remember that is second in line, so we calculate that. Secondly, well, thinking back to the question, you'll recall that the actuarial valuation of the pension lump sum was 18.5. Now, that's more than 10,000. So, in effect, what we're saying is that 10,000, that additional 10,000 that we would add on to provide the increased basic, to make it up to 29,340, isn't in play here. It isn't in play because the lump sum pension value, the actuarial value, is too high. It's more than 10. So in effect, the increased basic is the same as the basic. Okay. Now, third one, SESB, again, formulas in the tables. Tables are very useful in this area. It's just a question of slotting it in. There's the formula there that I've just stripped out of the table. Really what we're looking to do is just really slot the information in. A being the average annual emoluments, remember, to the date of termination, not to the date or to the end of the previous tax year. I would say in a long form question, what they'll do is that they'll only give you the salary information, benefit information up to the end of the previous year or for the 3 years. So let's say 11, 12 and 13, and then make you calculate the average annual emoluments for the 3 years up to the date of termination. In this case, because it's MCQ, they've done you a favor and actually given you the amount. So they gave you the 64. What's the B? Complete number of years. Again, it's in play. The complete number of years, not 12.5, it's 12. Okay, divided by 15, that's just an absolute number, and then less the value of the pension lump sum. So that was useful here also. That gives us 32, and when you look at, or when you compare these two, you'll see that clearly the SASB is higher. Therefore, that's the amount that we compare to our partially exempt group. We'll remember that the partially exempt value is 42. We take off the 32.7 to give us the amount that we would include in the income tax computation. Okay. So do look at that area. If some or indeed all of what I've said doesn't make sense to you, popular little area, termination payments. And as I've said, a lot of the information is ready and able for us in the tax tables. Okay. Next one is number 10. Next one's number 10. The answer in this case was D, obviously. Here we have CT losses, and a little bit of work to do here to make sure we get this right. So really what they're saying to us, how much of the trading loss for 2014 can be relieved against the case 1 income for the previous period. And the key thing really for us here was to notice that, of course, there's the loss there. That's easy to see. There's a case 1 loss. We should remember that for companies, we can go back 12 months, okay? So if we go back 12 months, then, how do we go back if this immediately preceding period is only 6 months? Well, clearly I think that what we can do is really take this up, or, gobble this up quite easily, but then recognize in the previous period, we would only really go 6/12. We have to go 6/12. If you think about it, we've done 6 months here. So when we go here, we can only max out at 6/12. There's another little twist in this question, which I'll explain in a moment. So in essence, what we're saying is, a limited company with a case 1 loss, how can it be used? Well, it can certainly be used by bringing it back or relating it back to previous years, and we can go back 12 months. And that's easy enough to do here, because we can say, as I've said below in my sort of mini loss memo, I start with 600, I take the 400 off for the 6-month period. I'm allowed to do that. That's perfectly reasonable and acceptable. What balance does that give me? It gives me 200. Now the twist here, and the reason why it might have been easy to make a mistake, the twist here is that if we're left with 200 after taking out the 400, certainly we can go back another 6/12, but unfortunately we don't have enough loss left. We've only got 200. So basically, in terms of going back to that period, we would only have up to 200 available. Okay. Hopefully that makes some sort of sense. Okay. So moving on to the next question. We don't have an answer for this either. This one is quite tricky because it sort of brings in this area of sort of residency and I guess DWT, dividend withholding tax, as well. So we just need to be careful. Okay. So what are we told? We're really told that Leisure Limited has or plans to declare a dividend of 25 and indeed pay it out to a series of shareholders. And a certain amount of rote learning for us to do here, really, in the sense that we need to know where DWT is payable and isn't. I think the other problem with this question is that the wording is a little bit tricky. It may not have been clear as to the exact nature of this 25,000. In other words, how exactly is that split? Is it gross or net, etc., etc. So really what I've done here is said that, if we have 25,000 being effectively paid out, we're taking that as a gross amount. Now, if there are 4 individual shareholders, then in effect we divide that by 4, okay, and multiply it by 2, giving us the gross amount of the dividend. Okay, so in this instance here, we're effectively saying that we have a gross amount of 12,500. Now, why is it only 2? In other words, why is it only 2 individuals where DWT will be relevant? And if we look up here, again, as I've mentioned, it's just really rote learning, and you'll see this information in the text. These 2 individuals here, this resident in the UK and indeed a company, apologies, resident, no, bear with me 1 second. This individual who's resident in the UK, basically the rule is that no DWT is payable, certainly UK or any EU DTA country, as I've mentioned here. So basically there is no DWT payable in respect of an individual who's living in one of these countries, of which UK is one. The second point here, and again, I guess it's just rote learning again, is that DWT isn't payable in relation to a company resident in Ireland. So really these 2 were just irrelevant, and whether or not we were able to fathom that out, as I say, it's a tricky little question. These 2 above, these individuals who are resident, then as far as the revenue are concerned, if you're a resident individual in Ireland, then in effect DWT is going to be payable. So I guess the key thing to recognize, certainly when it comes to individuals, is that residency in Ireland means DWT will be payable, and non-residency means DWT won't be payable. That would be the basic rule that I would follow. Over and above that, companies won't pay DWT. So where do I get the answer from them? I've said basically two of the above. I've taken 12,500 as being the gross amount, and I've multiplied that by 20% being the DWT rate to give me 2,500. Okay, and that's where answer A comes from. Okay. Next one is in relation to USC. Now, you'll recall that I mentioned above this area of USC and PRSI certainly lend themselves to MCQ style questions. Now, the problem with each of them is what do you include in the calculation and what do you deduct, if anything? Okay, question says, what's the amount of USC payable? Remember that the tables are certainly helpful here. We've got an individual who's got a salary of 64, rental income 1875, deposit interest of 2, and indeed dividends of 800, and they paid pension contributions. Now, the key trick with USC as opposed to PRSI is that dirt income, or the deposit interest, is not included. In other words, it's not included in the calculation. And in addition to that, pension contributions are not deductible, not for USC purposes or for PRSI. So, we'll see from the answer, I believe there is an answer to this one. We'll see from the answer that the gross income is basically these three items, which I think were the dividends, the rental income, and indeed the salary. DIRT income is excluded, and certainly the pension payment is not deductible. The only thing that would be deductible would be capital allowances. So if we accept that that's the relevant figure, in other words, totaling up all those areas, amounts of income and excluding the DIRT income, then all we've got to do is apply the information in the tables. It's all shown there, all the percentages are in the tables. So again, I know I'm repeating myself, PRSI and USC, think tables. Watch out for DIRT being excluded from the USC calculation, but included in the PRSI calculation, and watch out for how income is reduced for either one. The only thing that you're allowed as a deduction is basically, or the main thing, is capital allowances. Pensions certainly won't reduce income for either USC or PRSI. Okay, so that's number 12. The answer in this case is B as shown. Next one here, again, this is a sort of a non-core area, not covered in our class, certainly sort of low priority for me. We've just got this qualifying contractor. We have a repairs and renovations cost, and the question just requires us to detail what amount is going to be deductible under the home renovation incentive scheme. Now, again, that's pretty, for me, it's pretty low key or non-core. The answer in this case, you'll see it if you refer to the text, is simply a 50-50 split across 2 years to the following years, i.e. the year after next and the year after that. In this case, the answer was A, 74250 per year. Go back to the question, question itself. You'll see that that the key point here is that he's up to date in relation to LPT and household charge. So only on that basis is he allowed a deduction. And the issue that we have given that is to really calculate what the deduction is going to be. And really what we're required to do is really to take out the VAT element, the 13%. In other words, to look at the gross figure and take out the 13%, it will give us 1485, and really split that over the next 2 years, being the 742 in 2015 and 2016. Okay, so that is the answer to number 13, and that gives us an A. Okay, I wouldn't worry overly about that sort of area. Okay, this one here I would worry about because it's very examinable, very popular for the examiner to examine this. Quite a long question as well, a lot of information to digest for you. So really it's about averaging, or farmers averaging, and the averaging itself is not overly complicated, because basically what we're saying is, because of the nature of farming, that we simply average the 3 last years to give the correct assessable profits for the year. So that's not overly complicated. If it's a loss, we just include that as per normal. Now, what they're testing here is something slightly different, or at least an add-on to that. They're certainly testing this area of, do you know what averaging means in the first instance, but they're testing this area of opting out of it. And when an individual farmer, when he or she indeed opts out of the farmers averaging scheme, there's an adjustment that we may have to make, and it involves looking back over the 3 previous years. You'll remember that this caused a little bit of an issue in our class, and it certainly is a complicated little area. So in terms of what we're required to do, we're asked to detail which statements are correct in relation to his opting out of the income averaging basis. So what have we got? We've got a guy called Paddy, been trading as a farmer for many years, been using the income averaging basis since 2010. Remember that you've got to stay in it for 3 years. Now, he intends to revert to the normal basis from 2000, or indeed for 2015. They give us some details on his normal income for each of the years, and in effect what they're saying is, what of the statements below are correct. So quite a few little sort of pieces of work to do here, and coming up with the correct answer requires you to read the question carefully and just be do this on a step-by-step basis. In essence, this area of opting out of the average scheme really means that you're looking at the previous year. In other words, in effect, you're looking at the 3 previous years, and you're really comparing the 3rd last year and indeed the 2nd last year to the last year to see whether or not they are above or below it. Okay, if they're below it, you're bringing up either of those years. Remember, the 3rd last year or the 2nd last year, you're bringing them up to the level of the previous year. So that's why this sort of thing is certainly an examiner's dream and would cause a lot of stress, I suspect, within an exam. So, if we look through the answer first, and then I'll take you through why B is the answer in this case. We look at answer number 14. We basically see that his final year of averaging is 2014, because obviously he's reverting the normal basis from 2015. So what does that mean? Well, it basically means that 2014 will be on the normal averaging basis, as will 2013 and as will 2012. So what does that mean? Well, it basically means that, as I said when we kicked off this question, that we just take the average of the profits for those 3 years and divide them in 3. If it's a loss, we just deduct that. And really, that's what you'll see they've done down here. So I'll come back to that in a second. So really, what we're saying is that's his final year, 2014. Yeah, that's certainly going to be the average of those 3 years, 2012, 13, 14. And indeed, the 2 tax years prior to that will be the normal average as well. So you just go back 3 years. Okay. Now, what do you then do? Well, what they say is the 2 tax years prior to the final year of income averaging. In other words, these 2, the 2012, 2013. Remember that from here, 2014, that's when he's reverting to the normal basis. So it says that those 2 years will have to be revised upwards, so increased to the assessment for 2014, if the income averaging basis for 2014 is higher than the original assessments for those 2 years. So we need to work out what are the original assessments for those 2 years, and really that's what they do here. Now remember, we're given the information in the question, so all that we're looking to do is to use this information and say, okay, on a normal basis, what is the averaged income for each year? Well, we're just looking back at the 3 previous years, and that's what they do in the answer. Yeah. So for example, 2012, we just take the 3 divided by 3. That's the assessment. Okay, 2030, take the 3. Notice that there's a minus in there. That's the assessment. And indeed for 2014, as you would expect, that's the assessment. So we're really then saying for these two, yeah, we're comparing it to the last year of averaging. And we see, as I've mentioned here, here's the problem, i.e. that this one here is lower than the last year of averaging. Now, if it's a lower, we have to increase it, okay? So if we look at the answer, what we see is that this part B effectively says that the case 1 income for 2014 is 7. Yes, it certainly was. And 2013 will be revised upwards to 7, but no revision to 2012 will be made. Now, I'm thinking with this one, you know, the approach, I guess, wouldn't have been a process of elimination. In other words, when you see this sort of question, I don't think you go down all of them and think, well, is that correct or isn't it? I think what we need to do is to say, okay, this is an income averaging question. Therefore, there's a set process to really to get to the final figures. Let me get the figures first and then read the detail of A, B, C, D. Yeah, because the correct one should drop out. You should be able to see what the assessment is for 2014, i.e. 7, and you should be able to see that one or other of the years is going to have to be increased, or maybe neither of them will need to be increased. Okay, so I'd get the figures first and then come back to the question. Okay, hopefully that makes sense. So next one is number 15. And I'm not sure 100% on this question, to be honest with you. And the reason I'm sure is I'm not sure about the wording. What the question asks us to do is to detail which of the following is incorrect, or really losses. The answer in this case is capital allowances cannot create or increase a claim for loss under Section 381. You know, on the face of it, what we should know about 381, and we don't need section numbers, in my opinion, in the F6 exam. Certainly, we just need to know what the rules relating to Section 381 pertain to, and we should know that basically a loss made in the current year is just moved up the comp. In other words, in effect, Section 381 simply means we take the case 1 loss, let's say, for the year and just put it up the comp against other income. We sort of swipe the comp and really try and get rid of all the other income in the year. But this question is not strictly speaking about that. What it's saying is that capital allowances cannot create or increase a claim for loss under Section 381. Well, strictly speaking, it can, but you can under Section 392. In other words, you can simply take a case 1 loss, add in capital allowances, and use that loss as a Section 381 loss. So I'm not 100% clear on this question, to be honest with you. As I see it, it's tricky to sort of make sense of it, because in effect you can take a loss under Section 381 and add a loss into it under Section 392. Now, as I say, we don't need to know all the section numbers. I don't believe that at all. So I think this was a tricky little question, certainly a hard one. We need some hard questions in there, of course, but I think on the face of it, I'm not sure about the wording of it. Okay, so anyway, that is the summary of MCQ questions 1 to 15. Hopefully that's been helpful to you. If you do have any queries, do email me on it. I'll be uploading this now, so once you see it, it will be in front of you on YouTube. Do come back to me with any queries or questions.